It's a funny thing about the market. The moment a setup looks perfect, too perfect, it starts smelling like a trap. Every trader who's been around long enough knows that feeling. That quiet confidence right before the fall. And that, my friend, is what I want to talk about today, the setup that looks perfect until it destroys you. Now, before we dive into it, if you remember the previous video on the 3 rules for protecting profits, we talked about how the market punishes the man who gets careless with his winnings. Well, today's topic is the other side of that coin. Because sometimes it's not carelessness that wrecks a trader, it's conviction. Too much conviction in something that looks too good to fail. Picture this. You're staring at a chart. It's clean. The price has been coiling like a spring, volumes drying up, momentum indicators are lining up just right. You tell yourself, this is it. This is the move I've been waiting for. You can almost feel the profits before they come. You enter your position, confident, certain, even a bit smug, and then, out of nowhere, the market does what it does best. It makes a fool out of you. Why does it happen? Because the market isn't built to reward perfection. It's built to humble it. The setups that look the most obvious often turn out to be bait for the emotional trader. They pull in all the eager money, all the wishful thinking, and then, snap, the trap closes. Have you ever noticed that? How the textbook patterns are the ones that fail when everyone's watching them. That's the part of trading they don't put in books. The market doesn't pay you for knowing what's supposed to happen. It pays you for acting right when it doesn't. You see, a good trader doesn't fall in love with a setup. He courts it like a wary man courts risk, with a healthy dose of doubt. A perfect-looking chart is like a siren's song. It calls to your greed and your pride at the same time. You start thinking you've got it all figured out. You stop asking questions. That's when you're in danger. I learned early on in the market, the moment you stop questioning yourself, the market will start doing it for you. And her lessons aren't cheap. Think about it. How many times have you said, this can't fail? How many times have you gone all in because everything looked just right? The market loves that kind of thinking. It feeds on it. Because it knows that perfection in the market is an illusion, and illusions are what separate the winners from the ones who get cleaned out. Now, don't get me wrong. There's nothing wrong with spotting good setups. That's our job. But the trouble starts when you forget that even the best-looking setup can go bad. You can have the perfect pattern, perfect volume, perfect sentiment, and still lose money. Why? Because the market doesn't care about perfection. It cares about participation. And when too many people are seeing the same thing, the game's already changed. That's why I say when a setup looks too good, I get suspicious. I start asking, who's on the other side of this trade? Because if it's too obvious, chances are the professionals are waiting for the amateurs to load in, so they can sell right into them. Have you noticed how breakouts that look clean as daylight often turn into false ones? That's no accident. It's the market testing your discipline. You've got to remember, price action is like human behavior. It repeats, but it never copies itself exactly. The same pattern can work one month and fail miserably the next. That's why the good trader isn't the one who finds the perfect setup, but the one who reacts perfectly when things don't go according to plan. When I was young, I used to think the market was a puzzle. If I could just find the right pattern, the right signal, I'd unlock the secret. But after losing more than I care to remember, I realized something simply. It's not the setup that matters most. It's your reaction to it. The market's job is to deceive, your job is to stay undeceived. You might be wondering, so Jesse, how do you tell the difference between a good setup and a dangerous one? Well, you don't always. But you can feel it when you've trained your instincts. You can sense when the crowd is too excited, when the chart is too obvious. And that's when you pull back. That's when you let the others rush in. The professional trader doesn't chase perfection. He waits for opportunity wrapped in doubt. And that's where today's lesson circles back to what we talked about in the 3 rules for protecting profits. You see, protecting profits isn't just about managing your money after a win. It's about managing your emotions before you even take the trade. The same discipline that keeps you from giving back your gains is what keeps you from jumping headfirst into the trap of the perfect setup. Ask yourself right now, how many trades have you taken because they felt too good to miss? How many times have you looked back and said, I should have waited for confirmation? That's not bad luck. That's the market reminding you that patience pays better than prediction. I'll tell you something else. Every trader wants to be right. But in this game, being right too soon is the same as being wrong. You might spot the setup before the move, but if your timing's off, the market will take your seat before the show begins. That's why I never try to predict anymore. I observe. I wait. Because the man who waits for confirmation doesn't lose much. The man who jumps on conviction loses everything. You've got to train yourself to see perfection as a warning, not a signal. When I see a chart that looks flawless, I start looking for what's missing. Is the volume too clean? Is the sentiment too bullish? Is the risk to reward too easy? Because in trading, nothing easy lasts long. The market will always tempt you with something that looks effortless. Because that's how it keeps players in the game. But the truth is, real money is made in the trades that don't look perfect. The ones that scare you a little. The ones that make you hesitate. That hesitation, that doubt, that's usually where the opportunity hides. So next time you see that perfect setup, pause. Take a breath. Ask yourself, is this the market offering me a gift or setting a trap? Most traders never ask that question. And that's exactly why most traders lose. Because the market, my friend, is a mirror. It shows you who you really are when the chart looks perfect, and that's when it destroys you. Market perfection is an illusion built to lure emotional traders. It's one of those truths that only reveal themselves after you've taken a few punches from the market. Every trader starts out chasing the idea of perfection. The flawless setup. The crystal clear chart. The one signal that will make it all click. But the longer you trade, the more you realize that perfection in this game isn't just rare. It's a mirage. And the moment you start believing you've found it, that's when the market starts sharpening its teeth. You see, the market is a master of disguise. It knows how to dress up chaos in the clothes of order. It knows exactly how to make a chart look so clean, so convincing, that even the most rational trader starts feeling a little greedy. The candles line up just right, the moving averages converge, volume builds exactly where it should, and every indicator whispers the same sweet promise. This time it's real. And you, being human, start listening. That's the trap. Because the market doesn't reward emotional certainty. It punishes it. The moment you start feeling sure, you stop seeing clearly. You stop managing risk. You stop asking the most important question in trading. What if I'm wrong? Have you ever noticed how your biggest losses usually come from trades that felt the safest? The ones that seemed too obvious to fail. That's not coincidence. That's design. The illusion of perfection is dangerous because it feeds two of a trader's most destructive emotions, greed and pride. Greed makes you chase what looks good. Pride makes you defend it even after it turns against you. Together, they blind you to reality. The chart may be flashing warnings. Volume may be shifting. Momentum may be dying. But when you're emotionally hooked on the idea of perfection, you don't see it. You tell yourself, it's just a pullback. Or, the market's shaking out the weak hands. And before you know it, you're one of those weak hands. The professionals understand this better than anyone. They know that when the setup looks too clean, the public will pile in. And when the public piles in, liquidity appears. That's when the big players start selling into strength or buying into weakness. They use the illusion of perfection as bait. It's the oldest trick in the book. Let the crowd believe they're about to catch a sure thing, then take the other side of their certainty. You can see it play out time and again. Breakouts that look like they'll run forever, only to reverse violently. Pullbacks that look like the end of a trend, only to trap short sellers. Every one of those moments has the same DNA, perfection on the surface, deception underneath. The emotional trader only sees the surface. The disciplined trader looks deeper, asks who's being invited to the party and who's already leaving through the back door. The illusion works because we want to believe the market makes sense. We want to believe there's a formula, a setup, a pattern that will deliver us from uncertainty. But trading isn't a science. It's a battle of perception. What looks perfect to you might look overextended to someone else. What feels safe today might feel dangerous tomorrow. The market is always changing its rhythm, its tempo, its tone. It does that to keep traders off balance. Because if perfection ever existed, if setups worked flawlessly every time, the game would stop working. That's why great traders develop a kind of skepticism toward beauty. When the chart looks too clean, they get uneasy. When the move feels too obvious, they hesitate. They've been burned enough times to know that the market rarely hands out free money. They understand that true opportunities often look messy, uncertain, and uncomfortable. It's the emotional trader who needs the comfort of perfection. The professional thrives in ambiguity. Think about it like this. If everyone could see a perfect setup, then everyone would act on it. And if everyone acts the same way at the same time, who's left to push the market further in that direction? No one. That's why the perfect setup so often fails. It's already priced in by the time you see it. The market is forward-looking, and it feeds on imbalance. When perfection appears, balance has already been restored, and opportunity has already moved elsewhere. This illusion also ties directly to a trader's mindset. Many beginners believe that mastering trading means eliminating uncertainty. But mastery isn't about removing uncertainty. It's about operating calmly within it. The illusion of perfection is dangerous because it promises certainty in an environment that never offers it. And that promise seduces the unprepared trader into overconfidence. Now, this doesn't mean you shouldn't look for structure, signals, or setups. Those are tools, not traps, unless you let your emotions turn them into one. The key is detachment. You've got to approach every trade like a scientist running an experiment. You form a hypothesis, you execute with discipline, and you accept whatever result the market gives you. If the setup works, great. You are aligned with the flow. If it fails, you move on without emotion. The trader who chases perfection will always find disappointment. The trader who manages imperfection finds consistency. And remember, perfection isn't what makes a setup profitable. Context does. A chart that looks perfect in isolation might be sitting right under major resistance. A breakout that looks strong might be running into institutional selling. Without context, perfection means nothing. That's why the best traders read the story behind the setup instead of just the picture. So when you find yourself staring at that flawless chart, take a step back. Ask yourself, who's being fooled here? Is it the market, or is it me? Because 9 times out of 10, the illusion of perfection exists not to guide you, but to test you. It's there to see whether you'll act with discipline or emotion. The emotional trader sees perfection and leaps. The professional sees perfection and pauses. A flawless chart pattern usually means everyone's already seeing it. That's the quiet danger most traders never notice until it's too late. You stare at the screen. The setup jumps out at you. Perfect symmetry, tight consolidation, textbook volume profile, momentum just beginning to shift. It looks like the kind of move that could write your next success story. But here's the problem: if it looks that good to you, it probably looks that good to every other trader out there. And when everyone sees the same thing, the opportunity is already fading. The market is built on imbalance. Prices move because buyers and sellers are out of alignment. When that imbalance disappears, when everyone starts to agree, movement slows. Consensus is the death of opportunity. A chart pattern that screams, buy, to the crowd is already crowded. The professionals know this instinctively. They know that once the public recognizes the pattern, the easy money's gone. What follows next isn't continuation. It's competition. Think about those perfect breakout setups you've seen. The stock's been coiling under resistance, volumes drying up, every indicator shows strength building. The moment it breaks above the line, everyone piles in. You can almost hear the collective excitement across the trading community. It's breaking out! But then, Just as quickly, it reverses. Stops get hit, panic sets in, and the breakout turns into a breakdown. That's not random noise. That's the weight of too many traders seeing the same pattern at the same time. The market has a cruel sense of humor that way. It loves to reward anticipation, but punish expectation. When too many traders expect the same outcome, the trade becomes top-heavy. Everyone's leaning in the same direction, and there's no one left to push the price further. Have you noticed how the strongest trends often begin quietly, with no one talking about them, and how the weakest ones tend to die right after everyone notices? That's not coincidence. It's the crowd at work. The irony is that most traders spend years trying to find that perfect setup. They learn patterns, study books, follow gurus, memorize formations, the cup and handle, the flag, the wedge, the head and shoulders. They start seeing them everywhere, and when they see a perfect one, they act without hesitation. But the market doesn't pay you for recognizing patterns, it pays you for understanding context. A pattern's value isn't in how it looks. It's in who's looking at it. When everyone's looking at the same thing, the trade becomes a mirror of the crowd's emotion. That's why price often spikes just enough to lure them in before reversing. The professionals use those moments to unload their positions or enter from the opposite side. They've learned to read crowd behavior, not just charts. They understand that a flawless setup isn't a signal of strength. It's often a sign of saturation. Ask yourself this: if you see a perfect flag pattern forming on a popular stock, how many other traders are seeing it too? Hundreds. Thousands. What happens when all of them place their orders around the same breakout level? Liquidity builds. And where there's liquidity, big money moves. Institutions need liquidity to enter or exit without slippage, so they wait for those moments. The crowd provides the fuel, and the professionals light the match. That's why real opportunities often look imperfect. The best trades don't announce themselves, they whisper. They look uncertain, confusing, maybe even unattractive at first glance. The candles aren't lined up neatly, the volume isn't clean, the sentiment is mixed. That's where the edge hides. Because that's where the crowd isn't. When something looks too obvious, it's usually already too late. The truth is, the market's most powerful moves begin before they look perfect. Perfection comes after the move, not before. By the time a setup looks perfect, it's already reflecting what's already happened, not what's about to happen. The emotional trader confuses appearance for opportunity. The professional recognizes that the cleanest charts are usually the most crowded trades. It's the same reason why price often stalls near obvious resistance levels or rebounds from obvious support zones. Everyone's looking at the same lines. Everyone's placing their stops and entries around the same levels. The market knows this. It uses those clusters of orders as energy. Once those stops get triggered, price snaps the other way. What looked like the perfect breakout becomes the perfect trap. If you remember the principles from the previous discussion about protecting profits, this ties directly into them. Protecting your profits isn't just about how you exit, it's about how you choose your entries. If you're entering where everyone else is entering, your risk multiplies. The crowd's comfort zone is the professional's hunting ground. It's worth asking yourself, if everyone is seeing the same bullish pattern, who's left to buy? The answer is, not many. That's why the market starts turning right after the crowd acts. When sentiment becomes unanimous, the move is nearly over. The market feeds on disagreement. When that disagreement disappears, momentum fades, and the illusion of strength collapses. You have to train yourself to think differently. Don't look for what everyone else sees, look for what they're missing. Instead of chasing the breakout after it's confirmed, watch for where it might fail. Instead of entering when it looks perfect, wait for the pullback that scares the crowd out. The money isn't made in perfection, it's made in discomfort. This isn't just a technical lesson, it's a mental one. Most traders want certainty, they want to feel right. So when they see a perfect pattern, it gives them that feeling. It's emotional comfort disguised as logic. But comfort is expensive in this business. The trader who learns to stay calm when things look unclear, ends up taking the trades that the crowd avoids, the ones with real potential. The market is a master of balance. It always seeks to reward the minority and punish the majority. So when everyone's seeing the same thing, it's not a signal to follow, it's a warning to wait. Because the moment the pattern becomes obvious to all, the opportunity quietly moves on to somewhere else. True edge comes from reacting correctly, not predicting perfectly. That's the kind of truth every trader resists at first. When you're new to the market, all you want to do is be right. You spend your days trying to predict where the price will go, as if calling the next move is what separates the winners from the losers. You think that if you can just figure out what's going to happen next, you'll finally have control. But the market doesn't reward prediction. It rewards discipline. It pays the trader who reacts the right way when the unexpected happens, not the one who guessed right once in a while. You see, prediction is an emotional game. It makes you feel smart when you're right and angry when you're wrong. It keeps you attached to your opinions instead of your process. But trading isn't about proving your intelligence. It's about protecting your capital. The trader who chases the feeling of being right will keep losing to the one who focuses on acting right. Because no matter how sharp your analysis is, the market will always have the final say. And when it speaks, your only job is to listen and respond, not argue. The problem with prediction is that it builds ego. You convince yourself that the market owes you something for being clever. You think, I saw it coming, so I deserve the win. But the market doesn't care who saw what coming. It only cares how you manage yourself once the trade begins. That's why the greatest traders aren't fortune tellers. They're risk managers. They accept that they can't control direction, only reaction. Reacting correctly means being flexible. It means having a plan before you enter and sticking to it, no matter how tempting it is to improvise. When price goes your way, you manage your profits. When it doesn't, you cut the loss without emotion. Simple on paper, but hard in practice. Because reacting correctly requires humility, the humility to admit that you might be wrong, that you don't know everything, and that your job isn't to predict but to adapt. Ask yourself this: how many times have you been right about the direction but still lost money? Maybe you called the breakout but entered too early. Maybe you predicted the reversal but didn't manage your position properly. That's what separates the professional from the amateur. The amateur celebrates being right. The professional measures being effective. You can predict the market 10 times and still end up broke if your reactions are slow or emotional. Every trade is a test of character, not intellect. The chart doesn't care how many indicators you use or how many books you've read. It only cares how you behave when things don't go as planned. That's where the real edge lies. In the moments when your emotions want to take over and you choose discipline instead. Because the truth is, the market's greatest moves rarely look obvious at the start. If you're busy predicting, you'll miss the subtle shifts that only reveal themselves to those who are watching, not guessing. Reacting correctly also means knowing when to do nothing. Most traders don't realize that patience is a form of action. Sometimes the best reaction to market noise is stillness. You don't have to trade every move. You don't have to chase every tick. The traders who last are the ones who know when not to act. They wait for clarity, not perfection. They let the market show its hand before committing. This is where emotional control becomes your greatest weapon. The market constantly tests your ability to stay objective. It tempts you to predict because prediction feels like control. But control in trading doesn't come from guessing. It comes from preparation. You can't control what the market does next, but you can control how you'll respond to it. You can control your position size, your stop, your exit, your mindset. That's where consistency is built, not from calling the future, but from managing the present. If you think back to the lessons from the video on protecting profits, this idea fits perfectly alongside them. Protecting profits isn't about holding on to winners blindly. It's about reacting when conditions change. You protect what you earn by staying alert, not attached. The same mindset that keeps you from giving back gains is the one that helps you navigate uncertainty. It's all about reaction, not prediction. Have you ever noticed how the market seems to punish you right after you start feeling certain? That's because certainty breeds rigidity. The moment you believe you've got it all figured out, you stop adapting. You stop reacting. You start defending your prediction instead of managing your position. That's when losses grow. The trader who can stay fluid, who can change his stance the moment the evidence changes, survives where others break. In truth, the market doesn't care about your opinions. It rewards behavior. You could have no prediction at all, but still trade profitably if your reactions are measured and consistent. You cut your losses small, you let your winners breathe, you stay patient during noise. That's what the edge looks like in real life. Not magical foresight, but calm execution. Prediction makes you emotionally invested in being right. Reaction keeps you financially invested in staying alive. The trader who focuses on reacting correctly doesn't care about being right on any single trade. He's playing for survival, for longevity, for the compounding effect of many small right reactions over time. Because success in trading isn't built on a few brilliant predictions. It's built on thousands of disciplined decisions. That's why when people ask great traders, "Where do you think the market's going?" they usually smile. They know that question misses the point. The real question isn't where the market's going. It's what you'll do when it gets there. Doubt sharpens instinct. Overconfidence dulls it. Every trader learns that line one way or another, either by discipline or by disaster. In the beginning, you crave certainty. You want to believe that you can figure the market out, that you can predict its next move, that you can bend it to your logic. But the market has no respect for your confidence. The more certain you become, the more it waits to humble you. Doubt, on the other hand, keeps you alive. It keeps your senses sharp, your stops tight, and your ego in check. Doubt doesn't mean fear. It means awareness. It means you never let your guard down, even when things look perfect. Overconfidence is the silent killer in trading. It doesn't arrive loudly, it sneaks in after a few wins. You start thinking you've cracked the code. You stop second, guessing yourself, stop checking the risk, stop respecting the market's ability to surprise you, and that's when you take the trade that looks too good to lose. You size up, loosen your stop, ignore the signals turning against you. You tell yourself, "It'll come back." It doesn't. The loss hits harder than it should have, not because the market turned, but because you stopped questioning yourself. A good trader lives in a state of constructive doubt. Every decision comes with a quiet internal whisper. What if I'm wrong? That voice isn't weakness, it's strength. It keeps you honest. It forces you to manage risk, to think through contingencies, to plan before you act. Doubt keeps your capital safe. Overconfidence, on the other hand, feeds your pride. It convinces you that you're special, that this time is different, that you're smarter than the crowd. The market loves that kind of thinking, because it knows how to turn pride into pain. Have you ever noticed how your best trades often come when you're a little unsure? When you hesitate for a moment before pulling the trigger, when you double, check your reasoning, when you decide to go small just to test the waters. Those are the trades where your instincts are awake. You're alert, aware, cautious. You're not blinded by the illusion of control. That kind of doubt makes you careful, and careful traders last longer than confident ones. There's a big difference between confidence and overconfidence. Confidence is built on experience. It's quiet, steady, and humble. Overconfidence is built on ego. It's loud, impulsive, and dangerous. Confidence says, "I know how to handle whatever happens." Overconfidence says, "I know exactly what's going to happen." One is grounded in preparation, the other in illusion. The market always exposes which one you're operating from. Doubt also keeps you adaptable. When you doubt your own certainty, you stay open to new information. You watch the tape more closely. You pay attention to subtle shifts in volume, to changes in market tone. You stay ready to adjust. Overconfidence locks you in. You stop seeing the signs that contradict your position because you don't want to be wrong. You defend your bias instead of reacting to price. You become stubborn, and stubborn traders don't survive long. Trading is not a game of belief. It's a game of observation. The moment you start believing instead of observing, you're done. Doubt protects you from belief. It forces you to look for evidence, not comfort. It makes you test your setups instead of assuming they'll work. It makes you respect probability instead of chasing certainty. The most skilled traders aren't the ones who know. They're the ones who keep checking, adjusting, and questioning, even after years in the game. If you think back to what we discussed about protecting profits, it connects directly. Protecting your profits is a form of active doubt. You never assume a win will stay a win. You trail your stops, you monitor momentum, you guard your gains like they can disappear at any moment. Because they can. Doubt keeps you from turning a green trade into a red one. It's the same mindset that separates traders who keep their money from those who keep giving it back.